Welcome to Volume 5, Issue 27 of the Master Investing Newsletter. And this week's ex-dividend date is the 4th of July, 2019. Now, the FTSE 100 has been very, very interesting. Okay, what have we got? We were in this channel right here last week. This was Thursday last week. We're in this channel. So we've been there really for 2 weeks. And then as of Friday, we broke out. And today we're here. This is kind of like a little bit between, I think 11 o'clock and 1 and midnight on Sunday. But this is basically it, this one and this one here. And so we're now in this channel. So if it maintains this pattern, we're here. So if I go to the 15-minute chart, right, this is Thursday. This is Wednesday when we would have gone to the market, and we're in that kind of pattern, really. Thursday, Wednesday, Thursday, then Friday. We broke out, and then really we've been kind of, doing this now for today. And we can also see we gapped up. So this was the close of play on Friday. And then as soon as the market opened on basically 11 o'clock on Sunday, we had gapped up. And all of this upward move basically materialized here in out of hours trading. We gapped up, it came down a bit, and just basically marched right back to where it was, because we were here, and basically it's marched back up to this territory. And then it's come down a bit since then. But we've been on a little bull run. I did get a phone call today when I literally came back from the park, and they were saying, "Miles, why has the FTSE gone up?" And I said, I've not even turned my machine on today. I don't know what's going on. So, and when he told me that the main drive up happened around 2 o'clock, I assumed it to be, in fact, no, that's not correct. He said that the market had fallen from around 2:30, that's correct. And so I said, that would be, so check Wall Street, see what's going on. And he did. And Wall Street seems to be driving that downward move, which would be about here, actually, this little move here. Bounced back up and then kept on falling. So that would be America. But all of this is basically what's going on for us. Let's jump straight in and let's look at those candidates for last week. Okay, the first one was British American Tobacco. British American Tobacco. We were here on Wednesday between the green and the red line. Just zoom up a little bit. And then you can see the drop zone is marked in two phases. Here is the break even, and here is the exit price at the closing price. Now, this is more likely to be relevant when the share price ends on a high. And then you've got, based on the lowest price, the blue line being the break even here, and then you've got the exit price. And what does this do? Well, it gaps down from the high, tries to go up a little bit. That's actually a little retracement, and then basically starts to fall where it's supposed to fall to. And it comes very close to the break even at the worst price, and not quite close enough for the exit price based on the closing price. Anyway, what does it do? It finds support here. It finds support right here. And then it basically just starts to go up, and that's on Thursday. And then Friday, it literally just goes sideways, going nowhere. And then today, I don't know what was, when I saw this, I was shocked. I mean, this is like outrageous. For this company, by the way, this is not outrageous for companies that are sprinters, but this is not one of them. This is outrageous. I mean, I know it can sprint sometimes, it's got a sprint finish. He's like one of the Kenyan guys who can basically, run forever, do a marathon and sprint at the end. This is definitely one of those guys, because this is outrageous. And I know the FTSE 100 is rising today, but this is like, very impressive. And so you can see as of Monday, all long traders got their money back, all of them. This one doesn't have a good track record for long traders, but because it was the dominant company in FTSE 100 last week, by far in terms of capitalization. This is where the liquidity would have been, and they just wanted their money back, so they pushed it up. Now, if we look for volume, where's the volume to suggest what I just said? Where is it? Well, the volume, big massive volume happened right at the end of play on Friday. So this has been like pent up demand, which made it obviously gap up. And then we've got another push up here, but that basically only is pushing up. All of this momentum is not supported by the volume here. So this could be just market makers and other people pushing the price up. But this technically is not supported by high demand. Demand is not there, which is interesting. Then you get a big surge here, and then you get another surge right at the end of the day. So this is a bit surprising, but for long traders, they've been absolutely brilliant for long traders. So a British American Tobacco, for short traders up until Friday, because when I publish a newsletter, I publish it over the weekend. So it doesn't take account of Monday. So up until then, anywhere between -2% and 15% was what short traders made. And that takes you from -2 was from the red line to the blue line, or to the lowest point of this candlestick right here. And then the 15% would have been from the green line to, again, that 15, this line here. And that's taking account of the drop and paying the dividend. So I'm counting it from Wednesday, these numbers, by the way. And for non-professionals, between 1% and 5%. Okay, that's where that position is. And for long traders, they receive a dividend of 36.1 for professionals and 9% for non-professionals. But you can see that from 1:15 today, not only did the long traders pick up their 36%, but they also got a premium on top. Now, I've not done the calculation of the premium, but that basically is your move right there. And in fact, afterwards, we can actually do a calculation to see what that even represents. Because I know sometimes somebody asks, how do you calculate when you get a capital gain on your trade? How do you do that? Well, you just basically deduct your closing price from your opening price and then divide that number by your opening trade price. And so when I say opening and closing price, I'm talking about really the premium. So the premium starts from, let's say from the green line, but also start from wherever you came in, to be honest. Wherever you came in, that's where you are. And where you came out, so your closing and opening. And then divide that by your starting price times 5% or 20%, depending on what margins you get. And then that goes in brackets, and then multiply that by 100, and that's your number. And we can demonstrate that a bit later. Anyway, but those are numbers for British American Tobacco. Let's look at Burberry. If we look at Burberry, we were in this range between the green and the red line on Wednesday. We immediately gapped to the break-even line at the closing price, at the closing price here. And then from here, it bounces up straight away and then goes sideways. And towards the end of the day on Thursday, we see a nice move up. And then on Friday, everybody noticed this. It gapped up, and then basically we just went for the heavens. And it kind of plateaued around 12 o'clock. And it just kind of just said, we've done the move. And then today it gapped up again. And then it peaked around 11:15, went sideways and started to come back down again. I mean, this one was absolutely fantastic. And up until this point, this would have been a 60% premium, by the way, for long traders. Around 65%, I think it was, premium. But then if you stayed in some more, you got even more. So this was completely outrageous and rewarded us very well. And again, that's because the market was very bullish. So what was the return for short traders? Well, it's coming at this point, and basically anything for short traders happened in the first 15 minutes. After that, it was over. Anywhere between between -4% and 19% for professionals, and between -1% and 6% for non-professionals. And Burberry paid a dividend for professionals equivalent to 34.9% and 8.7% for non-professionals. Now, let me be clear, because I mean, I know most of you guys know this, but I'll be clear. When I'm quoting these numbers, I'm quoting the derivative dividend return, not getting a dividend based on buying the shares. So if you buy the shares, then those numbers will be much, much smaller. But when you base it on the derivative, the reason why it's higher is because you're only paying down a deposit. You're not paying the full amount. And that's why you're getting these enhanced dividend numbers. And that's really the secret of leverage. That's what leverage is, what's causing this to be the case. And that's one of the magic ingredients of making a lot of money. You need leverage. And that's why the property market works, because of leverage. And we're getting the benefits of the property market right here. So our dividend is our rent, our capital growth is the property price increase, and we can do all of this for less than the price of a £400,000 house. We can jump straight in and pay equivalent of 18 quid and get all the same benefits as a property market. And that's why I love dividend fishing. Because when I used to be a property investor, and I used to do all my analysis on spreadsheets, and then when I came across this model, I just thought, hang on a second, this is a property deal. It has the ingredients of a property deal. And so instantly it got my attention, instantly. And I said, okay, let me see what I'm looking at here, because I could recognize it straight away. And all I did was just type numbers into a spreadsheet, and instantly I saw a property deal in front of me, and it was dividend fishing. And instantly I loved it. If I was never a property investor beforehand, I may never have appreciated the magic of this system. But because I was, and I could see the numbers, it just jumped out at me straight away. So that's why I got very excited about this one. And I got so excited, I decided to teach you guys it. British Land Company was in this zone between the green line and the red line on Wednesday. It gapped down to the drop zone, and we're now basically here in terms. So this drop zone has two markings. Here is the break even, and here is the exit price based on the closing price, and here is the exit. Here is the break-even price, and here is the closing price based on the lowest price. These blue numbers are very relevant when the market is in a bearish trajectory, and the top and the gray and the purple number, or purple line, sorry, is very relevant for when we are in a bullish trajectory. And as you see from the FTSE 100, we're in a bullish zone, so we can almost ignore the blue lines for now, unless it's only blue lines. And so we can go with the top numbers, because these are more your bullish numbers, especially when the market closes higher. Anyway, so it gaps down to this purple line, break even, and then it basically hits the exit price, more or less. It touches it, nearly touches it there, nearly touches it there, nearly here, and again nearly here, and it was done. And that was on Thursday. And then on Friday, it just shot up straight away, and then literally headed for home. The green line being the finishing line for this particular trade, British Land. It was not quite there on Friday. Then on Monday today, it gapped up and we crossed the finishing line. Obviously, as soon as they got their money, those who need to get their money out, doing what we're doing, obviously dividend fishing, cause a downward trajectory because they're selling. But then at some point, then there's another move up again. And if you look here, if you look at the volume, there was another big volume purchase around here, and that stopped it from falling instantly, and then basically just carried on going up. That was British Land. We are in very, very bullish territory here. Had you gone short, you would have made anywhere between 4% and 22% as a professional, and between 1 and 7 as a non-professional. And you would have picked up 28.7% dividend had you gone long, or 7.2%. And you can see that you got your money back after receiving that dividend here on Thursday. You got your money back, and you've got a premium on top. Okay, you got your premium on top. That's British Land. So we've got 3 so far that's crossed the finishing line. The finishing line being the green line. Why do I make it the green line or the red line? Because obviously no one knows what price you're getting at, but everybody gets paid at the green line. So I just count the green line only. That's your finishing line right there. So now everyone gets paid. Last one for this week, or for last week, is Experian. Now Experian was at the bottom of the list. So, you know, I wasn't too ambitious for this one. Okay, so Experian is in this range between the green and the red line, and it basically hits this point, bounces up, and comes back down again. Now, this is pretty close to the bottom, so I need to done one calculation. And there's your break. This is your break even, and this is your exit price based on the lowest price. And this one shoots down into the drop zone, instantly finding support just below the break even, jumps back out again, does a retracement. It's still falling. And then it just continues to go in the direction it's supposed to be going in. It hits this low point here at 11 o'clock on Thursday, and then basically it looks for higher ground. It goes sideways, kind of having exhausted itself on the mad rush up. Then on Friday, it gets some more renewed energy and it starts to head uphill. It runs out of steam around 11:45 and then basically starts to fall and then finds support as it goes sideways for the whole of Friday. And then today, with all that pent-up energy over the weekend, this one literally gapped up. And it started from here, not from where it closed. So clearly there was out-of-hours trading, which pushed the price up and was reflected after. So this could have happened on Friday after the close, or it could have happened on Monday before the open. But I suspect it was really after the close. And then what does it do? Opens up here. It kind of said, whoa, we're going too high. It gets some ground, finds support here, and then basically drifts back up and just a little bit back up. And we kind of go back roughly to around this 4th one, but not quite as high as the top. And this basically is the movement for Experian. And we didn't quite get to the finishing line, which is the green line here. But as you can see, everybody, if you look at this line I'm pointing to now, everybody really, apart from the first 3 candlesticks, got paid their money back. So everybody after this point, 8:45. I have one who came in after 8:45 has got their money back. With this one, Experian. So what did they do? In terms of the fall, now this is a pretty deep fall actually. The short traders made anywhere between 20 and 41% for professionals and between 6 and 12% for non-professionals. So this is the biggest payout for short traders, Experian. And on the long side, they received 20.9% for professionals and 5.2% for non-professionals. Now, if you're going to pay a 20.9% dividend, let's call it 21% dividend, then half of 21 is 10.5. So the short drop should have been 10.5%, but this pays out between 20 and 41 for professionals. So you can see that this one falls by way too much. Okay. And very, very good for short traders. So this is one of the ones that feeds short traders very well. The others, British Land also feeds short traders very well, and everything else is like, and then all the other 3 they'll pay long traders again very well, and this one for most long traders. So really, when we look at it, if you've got a very volatile market which comes down very heavy and flies up, very aggressively, then what you've got is a model that pays short traders and long traders, and this is basically high volatility. And you get high volatility when the market gets a little bit volatile and concerned about the future. So when the future is uncertain, it makes the market volatile, which can be good for us. But we do know that there is this drop zone, we can calculate it. We know what it's roughly going to do. And based on the formulas I've given you, This is why I like this formula as well, because you know it's not going to drop down to nothing, because there is a zone it's going to go to, and then it goes back up again. And just so you can understand, when we are valued, and this is the secret to this, by the way, so I'm going to show you the secret now, why it's my mind. Before, forget about dividends for a second, let's go pre-dividend. This share price, someone thinks, is based on the profit a company makes multiplied by an average PE ratio. That's the price of the whole company. And when you take the PE ratio times the profits of a company, and the profits is really only revealed twice a year if they're based in England, or 4 times a year if they're based in the States. But really, it's the profits that they basically report, multiplied by a P ratio. That's your share price. That's the value of the company. Divide that value by the number of shares they have in issue. That's your share price. That's the valuation for this. So when they now pay a dividend, they adjust for that dividend. But let me ask you a question. Before this dividend drop, where was dividends calculated in this formula? And the answer, it wasn't. It wasn't there. Meaning this adjustment is a temporary adjustment, because once you adjust for the dividend, it goes back to the original formula. And the original formula is profit times P ratio. It's going to go back to it. So this is one of the reasons why it doesn't stay here. Unless, and by the way, the profit that they're calculating isn't last year's profit, it's the profit that is in the future that they're estimating. So it's a made up number anyway. Someone is saying, so if the company is expected to make less profit in the future, then the share price will drop, because you've got a smaller number being multiplied by the P ratio. But if they expect the profit to be higher in the future, then that's basically going to be a higher number. But it's always going to go back to the formula that was used in the first place. So this is one of the reasons why, as long as the profits don't fall, what you've got is a temporary calculation for the dividend drop. Then it goes right back to the formula that was always there. This is only a temporary thing. So this drop zone formula or drop zone phenomena is temporary, assuming and as long as the future profits are not falling. This is temporary. It's going to go back up. And that's why we experience this phenomena. So now you know the secret. You know why this works. And it's based on a fundamental, by the way, not technicals, based on fundamentals. Okay, let me close all of that and jump straight into what's happening this week. We have 4 candidates this week: International Consolidated Airlines, Coca-Cola, and this is not Coca-Cola making the drinks. This is Coca-Cola making the bottles that the drinks go into, and they're a Swiss company, which we'll go into that later. Then we've got Next, and then we've got Aveva. Now, Aveva is an engineering company, and Aviva, A-V-I-V-A, Aviva is insurance, but Aveva is an engineering company. So similar looking, but not the same. And between all 4, they are looking to pay £1.9 billion. And we can see as a percentage of payment, the 2 big ones are at the top. And if we continue down to this table, we can see that we've got some ridiculously high numbers. So let's see if we can break this down, because you might say, but Miles, you sure there's not a typo? Let's have a look what's going on. You see this dividend yield here. If you've got a 5% dividend yield, when you put it through a filter of 5%, this is 100% right here, 100%, if this is 5. So we know 5 is really a big number, but this is nearly 10. This is doubled that 5%. And so this dividend is massive. 9.6% dividend is massive, absolutely massive. And then you've got Coca-Cola trying to compete, 7.7%. 7.7%. And then you're back into, familiar territory, 2% and 0.7. Because these dividends are so big, when you filter it through the dividend and the derivative formula, you've got 192%. You've got 153%. Down here, and 39, let's call it 40%. And then if you come back down to non-professionals, you've got 48, 38, and 10. Now, when the dividends are so big, the story I keep telling you. when you have a snake that eats a pig, it takes a long time to digest this one. So be very wary about jumping in and going long. Be very wary. I'm not saying it won't do well on the upside. I'm saying be wary, because when you've got massive dividends, it does take a while for it to kind of digest. But again, I already told you the formula. If the share price is based on profits times P ratio, and the future profits is likely to be higher than the last year's profits, the share price is going back up again. It does take a little while. Okay, let's look at our first candidate. International Consolidated Airlines. Now, this is a company that has segments including British Airways, Iberia, Vueling, Aer Lingus, and other companies. And it combines the airlines in the United Kingdom, Spain, and Ireland. It has approximately 550 aircrafts to over 280 destinations. And then it goes through the capacity of their particular aircraft. And then it says it offers services in London, Madrid, Barcelona, Rome, and Dublin. The company's brands include the ones we mentioned earlier. British Airways, Iberia, Vueling, Aer Lingus, IAG Cargo, and Avios. William Walsh is a chief executive officer. They pay dividends twice a year. And how do you trade this company in the last 3 years? You would have had 6 opportunities to trade this company. Three times out of 6, 50% of the time, you would have gotten your money back within 1 week had you gone along. 2 times out of 6, 33% of the time, you would have gotten your money back within 11 days on both occasions. And once, 17% of the time, it would have taken you 68 days to get your money back, which is more than a month. And there was no time at all within the last 3 years when you didn't get your money back at all. What about going short? Going short 2 times out of 6, 33% of the time, made money on day 1, and once, 17% of the time, made money on day 2. 19% was ROI on day 2, and 8 and 11% was ROI on day 1. What about their fundamentals? Oh, before I jump there, this company is worth £9 billion, and they're number 46 in the FTSE 100. Fundamentals. We've got rising profits. 20.2, 22.9, drops to 22.6, up again to 22.9, and then 24.4. So the rise starts from here, 2016. The consistent rise. Rising here, drops, and carries on rising again. In terms of profits, which is the number that is the magic number for us, 828 million goes to 1.8 billion, up to 2.4 billion, up to 2.5 billion, and up to 3.5 billion. This company is doing well by all the relevant metrics. And if we look at this number, which is the measure of how well and efficiently they turn turnover into profit, you can see here 4.1, it goes up to 7.9, then to 10.5, 10.8, 14.3. Do you know what? I can tell you straight up, there is nothing more you can ask of this company than to make more money and be efficient in your cost control and practices. These guys are doing a good job. I don't know whether these early numbers are rubbish relative to them, but they are increasing this. Now, you can't increase it forever because you can't go up to 100. But the point is, they're doing well. They've had a nice 5-year run. They've had a nice 5-year run. What did we say? We said that they were going to pay dividends of 900 million. Here, they made a profit of 2.9 billion, and they've got cash of 3.8 billion. So paying £900 million is nothing to them. They can afford it without interfering with their operational activities. This is easy for them. And we also said that they had a valuation of, did I say, let me just double check that. What did I say? I said they had a valuation of 9 billion. Okay. And we can see that their net assets is 6.7. So they are trading at a premium on the net assets. Okay. This, by the way, is, unless they are very, very heavily got a large balance sheet, this is normal. Okay. And for companies that don't need too many fixed assets, then this is going to be, the turnover, well, the profits will be much higher. I'm sorry, the valuation will be much higher than the actual net assets. So this is a pretty healthy looking company. It is pretty healthy. And if I look at the P ratio, this is the price to earnings ratio. In other words, we can see it's falling. 10, 8, 5, 7, 4. The smallest number is, the better the bargain is. The higher the number is, you know, the less the bargain. And if it goes too high, like 50 and 60, then we'll talk about something that, unless you are seriously, you know, on track to make a lot of money going forward, it may prove to be not a good deal. But this looks like a healthy company that's got a good price. So what we've got to wonder, if you wanted to go into this one and buy it and hold it, the other question is, what's the industry forecast? Because you can't just base it on today's numbers going forward. And you can just they're always forecasting, these companies, so you can look at the forecast and just find out what are they up to, and you'll maybe just can Google it and see what the forecasters, what the analysts are saying the forecast will be for the future and what they think it will be. And obviously the share price today is based on that anyway. So the current share price is an indicator of that. And we can look at that now. So what have we got here? We've got this company. So it was kind of in this zone. And then from 2016, it started to march upwards. And in the middle of 2018, it started to come down. Now that's kind of interesting, because someone thinks that the forecast going forward is actually going to be less than it is now. So even though they're making more money, the forecasters are claiming that they're going to not doing as well going forward. That's interesting. But these things you've got to pay attention to. Okay, Coca-Cola. It's a Switzerland-based bottler of the Coca-Cola products, so it's not the whole thing here. The company segments include established markets, including Austria, Cyprus, Greece, Italy, Northern Ireland, Republic of Ireland, and Switzerland. So let me just stop you there. Coca-Cola, the company, not only do they make a drink, which is branded, but they also have to put it into a container, a bottle, a can, and so on and so forth. And so this company is really in the supply chain of the Coca-Cola company. So this company exists because we like buying Coca-Cola. All right. And so they decided that they're going to handle the bottling and making and either put it into bottles or making the bottles. This is their sole existence. They are in the supply chain of Coca-Cola, the company, and that's their job, to look after that. And the reason why I bring this to your attention, because if you can figure out how to build a business that is in the supply chain of a very large multinational company with deep, deep pockets, you will make a fortune. And let me tell you which kid figured that out a long time ago and did exactly that and made a fortune. His name was Bill Gates. Bill Gates decided that he wanted to be in the supply chain of a company called IBM. IBM was making all kinds of computers, and they were literally the godfathers of IT at one point in their history. And they was known as Big Blue, and they literally had the market to themselves. Okay, but they were focused on the big institutions because they were a big company themselves, and they would be the big boys. And what happened with IBM is that they realized that there was a little market, for consumers who want to buy a little tiny company, and they really couldn't be bothered to get the whole supply chain in their system because they were managing bigger companies. And the big fish is what they really were focused on. So they decided to have a little company, a little computer, and they asked this little, kid from, he dropped out of university, could you supply us with some software? And I believe his mother knew an executive in IBM, and that's how that door was really opened. It wasn't just him being a complete nobody. His family kind of knew insiders. But the bottom line is this. Once they realized that this kid was the real deal and could supply, or they had confidence he could supply, he got a contract to supply software. But the funny thing is, he didn't have the software ready. So we had to physically go to another company and buy the software off them and then license that software or rent the software to IBM. Now, because he put himself in the supply chain of IBM's business, when IBM started to sell their computers all over the world, they literally were on this roller coaster and they made a fortune out of it. And because he decided to keep complete control, not sell the software, but rent it to IBM and then have the rights to rent it to other people, was a bit cheeky because most companies won't let you do that. He then was able to, and because IBM was a standard, when all the other guys realized that there was a market here, and they would make computers and they call them IBM clones. And the IBM clones didn't care about the software, and so they rented the software from Microsoft. And this made basically Bill Gates one of the richest guys in the world, just because he was in the supply chain of IBM. Why am I telling you all of this? Because these guys were in the supply chain of Coca-Cola. And if you can figure out how to put yourself in the supply chain of a massive organization, right there is dollars. You're going to make money. Because there's nothing for you to do other than to give the big monster, whoever the big monster company is, give them what they need and make it easy for them to say yes to you. And just keep on supplying them. And if you can do that, their own momentum is going to take you. It's like being an insect, like a flea, and you jump on the back of a massive elephant. After that, there's nothing for you to do. Just sit on the back of the elephant. He'll take you all over the place. He'll take you where he's going. And all you got to do is sit on the back of him and enjoy the view. And that's basically what these guys done, what Microsoft did, and what every other smart individual who becomes part of the supply chain of a large company. Okay, makes your life easy. Also difficult too, by the way, because you're vulnerable to them, getting rid of you. But the bottom line is, it's one of the quickest ways to do well. Let's continue. The number Coca-Cola, the bottler is number 14 in FTSE 100 with the valuation of 10.7 billion. What else can we say about these guys? So, in the last 5 years, by the way, these guys pay dividends once a year. And in the last 5 years, you would have 5 opportunities to trade this company. 3 times out of the 5, which is 60% of the time, you would have gotten your money back within 2 days. Okay, and twice, 40% of the time, it would have taken you more than 30 days to get your money back. 39 and 42 to be exact. 39 and 42 days. What about going short? Twice out of the 5 times, which is 40% of the time, you would have made money on day 1 and on day 2 going short. ROI on day 1 was between 5 and 17%, and the ROI on day 2 was between 4 and 22%. And that's basically your performance, or the performance for this company. Let's look at them in terms of their business itself. 6.5 billion, drops to 6.3, drops 6.2, bounces back up, 6.5, 6.7. Profits, the real number, 352, 357, 458, 565, 611. I mean, I would say this is well managed. And here's the proof right here. 5.4 profit margin, could be small, but not for this kind of company, because remember, they can't sell their bottles too expensively, because remember, they're part of the Coca-Cola supply chain. So Coca-Cola can't be selling their Coca-Cola for £20 a bottle. There's a restriction here. So their margins can't be too high. So they said this company is all about cost control, because they can't sell it for what they want to sell it for, because they're part of the Coca-Cola. They're part of the Coca-Cola supply chain. 5.4, 5.6, 7.4, 8.7, 9.2. All the numbers are going south. They've had a really good 5-year run. It's good. How much do they want to pay? They want to pay 829 million. 829 million. They have profit of 448 and they have cash of 712. So this is going to be a challenge for them. I have no idea why that number is so high. Now, either they've, okay, a couple of reasons for it. So this might need more investigation. Either there are those shareholders, there's 362 million shareholders. Now, if they're all, they may have different classes of shares, some which they pay dividends to and some which they don't. So if that's the case, then that will explain why the profits are this size when the dividend is higher. But if they're paying that dividend, £2.28 to all their shareholders, then this becomes a little problematic. So I might need to look into find out exactly what percentage of those shareholders or the shares are going to get this money. But it looks like they can't afford it, basically, is what I'm trying to say. So that's problematic right there. If we look at their valuation of 10.7 billion, they have assets of 3.6. So they're trading at just over 3 times their net asset value. And they have P ratios between 19 and 21. So let's say 20. And if you look down here, a P ratio of 20 gives you a number equivalent to 5% per annum. Okay. And this, by the way, for this kind of company in FTSE 100, I would say is about right. Okay, 5%. Meaning a lower P ratio gives you higher return per annum, and a higher one gives you smaller. But 20 kind of appears to be their number. Okay. What's going on for these guys? Well, since 2016, share price has been rising, and then 2017 it plateaued. So end of 2017, all of 2018, the share price is flat. All of this time here, and then started to dip towards the end of 2018, and then 2019 we're back on the uptrend again. We're going back up again. Coca-Cola are clearly selling more of their product, and then these guys as bottlers are having to basically bottle more and more product. And so it looks like their future is looking, the forecasters anyway, and analysts believe that their future is good. Next PLC is a UK-based retailer. Now, they're actually based in a place called Leicester in the Midlands. And they've got a big, massive headquarters there. And I used to kind of go there regularly because there's a couple of farms nearby, not on this road, not where they are, but just down the road from them. There's a couple of farms which I used to go to just as kind of a place to chill out and just relax when I was in the Leicester area. And so I got to know exactly where these guys are located. And I remember, what was it, about 4 years ago now, we had an issue where I wasn't quite sure what they were doing with their dividend payments and stuff. And so I rang them up and I spoke to, I was trying to get hold of the director of finance. Now that's an achievement for a company this size, by the way. Just go and turn up and speak to Amanda. But I was trying to get hold of Amanda James, and they put me in touch with the director of investor relations, whose name I don't remember, but it's a lady. And again, they were incredibly helpful. And what I learned from that person is that this company treats shareholders like they are the kings and queens of the world, because they will look after you, and that the whole company is designed to look after you, and they are incredibly focused on that. So it's just part of the culture for this company. Whether they do well or not is another matter, but they will definitely, it's in the culture to look after you. So when I call them up, I mean, I was treated like I was a king, because they just consider shareholders to be that way. These guys pay dividends quarterly. They're number 56 in the FTSE 100 with a valuation of 7.5 billion. In the last 7 years, had you bought this company, you would have 14 opportunities out of 26 to trade this company. That's 54% of the time. And had you done that going long, you'd have got your money back within 1 week. 8 times out of 26, 31% of the time, it would have taken you less than a month to get your money back. And 3 times out of 26, more than a month to get your money back. And once, 12.99 days ago, when you didn't get your money back at all. How about going short? 17 times out of 26, which is 65% of the time, you would have made money on day one, and 62% of the time, which is 16 times out of 26, you would have made money on day two. The returns on day one maxes at 27%. It maxes at 31% on day one, and on day two, it maxes at 58, but 58 is an outlier. So if I go to the next one, that's reasonable for this company is 36. Yeah, 36. So there's quite a few of them in that range, 36, 35, 30, and then down to 23, 22. So yeah, these guys will kind of, the share price is volatile enough to feed short traders and non-traders. $4 billion, 4.2 billion, drops to 4.1 billion, drops again to 3.9 billion, and then back up a bit to 3.9 billion. Profits, 795, 836, 790, drops, 726, drops, 723. These guys are clearly not having a happy time. And I find this one interesting. If I look at their ability to convert sales into profits, 19.9, 20, 19.3, 18.8, 18.5. It's between 18.5 and 20. Now, I know these numbers look like they're bobbing up and down, but this is pretty consistent numbers. They're in a very tight range. So they're being the costs are being controlled. This is not an accident why the numbers are in this thin range. They're being tightly controlled. So you've got good accountants there who know what they're doing. They may not be the best in the FTSE 100 for doing this, but they've got it under control. They want to pay a dividend of 147. They got profits of 590, that makes sense, and they got cash of 156. So here's the question. If you're making all this profit, why isn't it in cash? Well, your profit is determined by you selling a product. Now, if you sell a product on credit, i.e. you sell something and someone pays you back later, then the cash is not there. You know, if you sell and you put them on a payment plan, the cash is not there at the time of the sale. So this counts the full profit, and the cash counts when the cash eventually trickles into the business. But they want to pay 147 and they got 156. They're gonna have to borrow the money. They have to borrow the money. Right, what's their valuation? 7.5 billion, and they've got a 5.5 billion assets. Well, they're selling at a premium on their net book value, which makes sense. But this is going in the wrong direction from a fundamental point of view. So the question is, what will the trend look like? We can see a decline bounce back up again and declining again. And then it kind of is, so basically somebody believes that the share price, so next year's profits, they believe going forward would be better than last year. So that's why it bounced. But then it's plateauing again. So I wonder, is this a terminal decline? And because of the business that they're in, I mean, they're selling, you know, all kinds of stuff, clothing and furniture, and these are not perishable items. But when you're in the fashion business, you know, something going out of fashion can make your product perishable. So next, and I do know people who use this business as a customer and they abuse it. So I know they're open to abuse. You know, people basically buying their product, using it, not using it, and then bringing it back and then getting all their money back. I mean, I know I've seen this in a bit of abuse, which bothered me when I was seeing it. And this is for people who kind of, you know, I don't know what to say about this, other than to say that I'm not sure. The numbers say what they say. I'll leave it there. Okay, so let's do a quick summary of what we've said so far. In terms of going short, we've got Next at 65, and we've got Aveva, which we didn't tackle, at 64. Again, you guys, but you know what? Let me quickly go to Aveva so you know. I won't go into detail, but I'll put it on the screen so you can see it. And then you can pause it here and then read it. But this is what they're about. They're an engineering company and they've all this range of stuff. So I just leave that there for 2 seconds. 1, 2, there you go. You can pause it and then come back if you want to. But that's what they're about. The number 67, the FTSE 100 with valuation of 6.5. And I'll leave it there so you can see the numbers. And again, you can pause it on that. And if we look here, their profit margin is declining. So they're in an unhappy state of cost control. So something has gone wrong here. And depending on the kind of business they're in, either this is going to be an easy job to manage or a hard job to manage. But if it's easy to manage and this is happening, then their accountants need to be either get retrained or they need to, they got to sort this out. This is not good. All right. And then we've got 60% for Coca-Cola. So let's look at this one here, the Coca-Cola one, 60%. Now, because what we want for this, we want Coca-Cola's track record to be having low numbers. So there's Coca-Cola here. And we've got 42, we've got 39. That's not good if you want to go short, if you want to go long. Here, very good last year. 2016, very good for going long. 2014, good for going long. So it looks like, you know, good for short, good for going long, not. Good for going long, not. Good for going long. If that was a pattern, next time around will be not good. Obviously, you can't base it on that simple way of looking at it, but this can be either horrible for going long or good for going long. Last year it was good. And it's literally spread out. I'm not quite sure what's causing that. And then what was the other one? And so now let's look at Next, going short. Now, if you want to go short, you want numbers to be big. Where is Next? Next is here. 78. Now, if it takes 78 days to recover and across the finishing line, which is the green line, and you want to short it, this is a great number. 5 is kind of okay for Friday and the Thursday-Friday trade, but you really don't want it to be too small. This one, no way. If it's going to do this, you can't be shorting that. You can't be shorting that. You can't be shorting that, and so on and so forth. But let's go with recent history. So let's go from here. That is fantastic for shorting. As long as it doesn't plateau and go sideways for the whole time. Great for going shorting, and this is fantastic for going shorting. So this one's a mixed bag of, you know, doom and gloom and optimism. But the last time they did a sprint finish and was in 100-meter races with Usain Bolt, I was in 2016. No, sorry, 2017, right here. So you can see the numbers for yourself. And yeah. Who was the other one? The other one was Aveva, wasn't it? 64%. Let's look at them. You got 5 days, 8 days, and then you got sprint finishes right here. This is not good. Not for going short. And then this is fantastic for going short. And then, you know, so are the others apart from that. Okay. Intercontinental, fantastic for going short, 68 days. 11 days, kind of okay. This is not, 1 day is not, and 1 day here is not. 7 days, you know, you know, a lot could happen in 7 days, so that's not too bad. But 1 day is definite. Don't touch it. From a short perspective, it recovers that quickly. But what we got here last year, it was a bit of a slap, you know, couch potato going slow on the long side. So these are your numbers historically to kind of give you an idea of how to interpret this table. Because obviously, if this is recent history, good. And if it's remote history, again, not so good. Economic calendar. For Monday, we've got net lending, mortgage lending, Bank of England, consumer credit. We've got manufacturing data, and we've got mortgage approvals. Tuesday, nationwide housing, year-on-year, month-on-month. Construction, 5-year Treasury gilt auction. On Wednesday, we got market CIPS services data. We got Bank of England giving a speech. And then Thursday, we've got new car sales. Friday, we've got Halifax this time. We had nationwide on Tuesday. We got Halifax on Friday. Bank of England, Finance Policy Committee meeting. And then we've got labour productivity data. And that's basically what we can expect this week. Now, whether you guys are thinking, well, should we hang around in the markets or should we kind of just keep our powder dry for next week? Let me show you what's coming up next week so you can make a decision. It says here, we have a company called Halma paying a dividend of 0.5 with a derivative yield for professionals at 4.8 and 2.4. Now, you know, if this number is not 20%, I'm not even interested in looking at it. So if this one doesn't have any more company next week, you know, we might have a holiday and just, I'll put a video out there for you, but I won't be necessarily spending time analyzing this company. And this company, I've never looked at this company ever. And all the time I've been, you know, doing this system, Halma has never come on my radar. Again, because of this, for this reason, they're too small. According to Nelson Mandela, the late, great Nelson Mandela, money won't create success. Freedom to make it will. Now, I know he's speaking in the context and the, you know, of South Africa, but he says money on its own won't create success. The freedom to do it will. Now, in a way, I think he's right, because you do need to be in a country where there are economic and political freedoms that don't interfere with your ability to basically be successful, because you could be in a country where you make money and the governments want to steal it from you, you know? And in those kind of environments, you really don't want to be setting up business and trying to do well, because you're just up against, you know, insurmountable barriers. So you do want the country you're in to have an economic and political system that says, that basically believes in fair play. Let's be blunt about it. You want someone involved in fair play. And if you were in South Africa during the time when Nelson Mandela was in prison, that was not the case for majority of the population. It wasn't a case of fair play for them. They would have got blocked if they had the wrong hue. So, you know, I get why he says what he's saying. Now, for me, being born in England, I've been spoiled from the day I was born until now. And I didn't have to go the horrors and the trauma that Nelson had to go through. But he's right. Money won't create success on its own. the freedom to make it, and having a supporting environment that won't get in your way. That will. Let's open the microphones. Any questions? Now's a good time to ask. And Nzinga, you have your hands up, so I'm going to ask you first.
Hello.
Hi, Nzinga.
Hi, good evening. Yes, the first question is, you've mentioned about trading out of hours. How does that work?
Okay.
That's question number one.
Right. Well, hold on. Let me ask that question, and then you can bring another one, because I don't have a pen and paper in front of me. So let me ask that question. 15 minutes before the market opens, 15 minutes after the market closes. There is something called an auction.
Oh, okay.
And that's mostly for the big boys, but you can also join in as well if you want to. And how you would join in, you can ask IG Index to basically just allow you to have access to that, and you can.
Right. Yeah? Okay.
But they'll put you on a slightly different platform, but it allows you to basically trade before the market opens. And if you need to participate in the auction, then you can. And what tends to happen is that you basically, again, like all auctions, you just put in a bid. So let's say you want to buy, say, Marks and Spencer's, and you'll put in a bid at a certain price, and the price might be, let's say you want to go long. So let's say the price is, say, £2 right now, and I might say I want to buy it for £1.80, which I want to buy it cheaper than it is right now. Well, clearly that's not going to get filled if the price is £2, but I can put in 180 anyway. And what will happen is that me putting in that price, when the market opens, you get this wild volatility straight away. When the market opens, you see it in the FTSE mostly, and my 180 might fall and bounce up and fall and bounce up, but it will kind of zigzag, and if it hits my 180, my order will get filled. So that's one way of doing it. Or I can just basically just jump in and, if I've got very deep pockets. Now, the ones who tend to want to not be participating with the general public, let's say, are institutions, even though they do actually do trading in trading hours, but they're the ones just want to just kind of just do what they got to do and then move on. And they're going to take big positions, but they won't be doing what we're doing. They'll be taking big positions. So, but there is a 15-minute window before the market opens and after the market closes, when there's like an auction that takes place, and then that allows you to participate.
Okay, thank you.
You got a question?
Yeah, it's about when you say the word technical and fundamental.
Yeah.
I want to know what that, I'm just trying to understand that.
Okay, let me explain. From the stock market perspective, a fundamental has more than one basis for it. So my background is an accountant. So as an accountant, when I'm thinking of fundamentals, I'm thinking about things that are real, that actually affect the company. So what for me is real? What's real is that, let me just show you here. Now, again, I am biased, so you can't just take what I say alone. Why? Because even though I'm going to tell you now, it isn't the main driver of the stock market. It's only part of it. So let's say, for example, this is a list of the performance of the company. So they really did make 6.5 billion. They really did make 6.6 billion. Yeah. Mm-hmm. They really did make, after tax, 427 million. They really did make, in next year, it did increase. And the year before that, it was lower. So it's an increasing trend. Okay. This is really happening. This is a fundamental. Yeah, this is what I call a fundamental. It's real activity taking place. Now, let's imagine me and you and Nzinga are wanting to buy, 25% of Coca-Cola, right? Because we've done really well, and in 10 years' time, me and you want to purchase it, but we're in disagreement, right? And so we have a falling out, and then we decide to purchase it on our own, right? Me and you trying to buy and sell the shares can cause the share price to move, especially if we have deep enough pockets. Now, Coca-Cola is a bad example because Coca-Cola is massive, but let's say nonetheless, we had a couple of £1 billion, and we want to basically, and let's say our egos are involved in the bidding, and we just want it for reasons outside of whatever we want it for. I want it, you want it, and we're fighting each other for it. We can push the price up. We can make Coca-Cola share price go from £24 a share up to about maybe £50 a share. We can do it ourselves if we had a big enough, deep enough pocket. Now,
is that by just saying, I'll pay this for it and you'll pay that for it?
No, it's actually trying to buy it. We can't just say it, we've got to do it. So we have to basically be going, putting out, physically just going to buy it. So in the old days, I'll call my broker up and I'll say, John, I want, 25 billion shares. And he'll say, Miles, come on, behave yourself. There's not that many out there. I said, I know, but buy what you can. Buy it slowly, but buy them up. Now, here's the thing. The market makers aren't even the first ones to notice that the liquidity is gone. In other words, they're the ones holding the stock of shares. So when basically, so if I'm buying and selling, I don't sell to you, you don't sell to me. We sell to the market makers. So the market makers know what's going on, right, in the marketplace. They'll know whether or not there's too much out there, too little out there, what the demand is. If I go shopping and you're going shopping and we're fighting over this, they'll be the first to realize something's going on, and they'll push the price up.
Right.
And then the reason why they'll push the price up is because they want to encourage other people to sell the shares so we can buy, because they're going to try and facilitate our craziness, right? So they'll push the price up, persuade people who already have it, sell your shares, because we've got 2 people out there who want to buy this company, and they'll push the price up. And then that way people sell, they get the stock, then they can sell to us, because by selling to us, they make money too. Yeah. And so that is now me and you competing for shares is what I call technical. That's supply and demand. Yeah. That's us. Nothing to do with the company. They're still making the same number of bottles that they made in the previous year. Nothing's changed. Yeah. They're still paying the same dividend. Nothing's changed. The same demand for the physical product in the marketplace is still the same. Nothing's changed. What's changed from a technical perspective is me and you are competing, which has nothing to do with the company. Do you understand?
Mm-hmm.
So the emotions around supply and demand, the emotions around fear and greed is what is being measured in MACD, in RSI, in Ichimoku, in the Bollingers. It's that demand that is really driving all of that. And all of that is really, let's make it simple, it's supply and demand. And supply and demand for the shares has nothing to do with the fundamentals of the company. And so when I look at all of these oscillators, they're all based on supply and demand. So I call that technical. These are technical reasons why the share price is moving. Okay, but the fundamental of why the company is even worth anything at all is based on what you're looking at on the screen. These are the fundamentals. And then the technicals is to do with me and you having an emotional, falling out over who wants to own Coca-Cola. Do you know what I mean? And you might be saying to the Birmingham Massive, yeah, man, we're going to take Coca-Cola from the Londoners. And I'll be saying to my posse down in London, no, man, we can't make the Brummies have it. We've got to have it. Do you know what I mean? And we have some kind of like trade war going on. That kind of stuff is really a technical stuff, because the minute me and you start fighting, the share price goes back to normal again.
So was that what was happening last week and today?
In relation to?
The FTSE rising and shares like Burberry rising? Again,
it depends. So I would say with Burberry rising, I don't think that was fundamental. I think that was technical. I think...
Yeah, exactly.
I just think there was a demand out there. Look, you see my little videos that I do, I've been sending out. If I had a large audience, a large enough audience, I can make the market move myself. Just by putting that information about a company, saying this is a good company, it's not a good company, people are buying into my analysis. I mean, I'm assuming people are intelligent, so they will look at my analysis and think, you know what, this guy's on something. I'm going to jump in, because I'm going to one day talk about a company as a real good bargain, not because I made it a good bargain, because I just spotted it, because I'm showing you this data. Now, unless you have my background, why would you even look at this? Most people wouldn't even look at it. Now, the analysts are looking at this for certain. The guys in the professions, they're looking at this for certain. But why would regular Joe look at this? And unless you have an accounting background, you wouldn't. Do you know what I mean? But if I
Yeah.
do a little video and put it on Facebook and I persuade, you know, grandma and granddads and your uncles and aunties and your cousins to go shopping, you know,
Right. Right.
and
Yeah.
I do it to a community of about maybe 4 million people, and they go buy it. 4 million people on its own is a demand that I was going to make an impact,
Wow. Yeah.
especially if you turn it with £1,000 each. Do you know what I mean?
Mm. Got it. Thank you.
No, you're welcome.
My last one quickly was like you said that to follow up about the company fundamentals. I'm still trying to understand.
What's your question?
I was saying to you that if I wanted to buy a share for a long period of time, for many years to hold,
Yes.
the key things to look at when you talk about the fundamentals, just to work it out, to see if that company is something to look at, to invest in
Okay.
long term.
So let's say I want a company and I want to keep it for about maybe 5, 10 years.
Yeah.
First thing I want to do is I want to look at their track record.
Okay.
This fundamental track record. Now, the share price, I don't want to look at straight away. The share price comes later. I want to know the basis. And by the way, let me just say this right now. 20% of the reasons why the share price moves is based on this fundamentals. 80% of why the share price moves is supply and demand. Okay, somebody creating a rumor, someone's going to buy this company. This is all stuff to do with, you know, greed and fear, emotions, all of that stuff, human behavior. That's technicals.
Sorry, say again. So it's 80% is for technicals.
Correct.
And
So the fact that me and you are fighting over Coca-Cola because you want to buy it for Birmingham, I want to buy it for London. Yeah, that's a technical thing. Nothing to do with the Coca-Cola business itself.
okay.
What's on the screen, as in how are these guys making money? Yeah. Now I know who we're looking at now. We're looking at Coca-Cola. So Coca-Cola is a strange one because they're part of the supply chain for Coca-Cola, the big, you know, the actual corporation, American corporation. But they're basically solid. They ain't going nowhere. You know they're in business forever. As long as Coca-Cola's in business, they're in business. Do you know what I mean? And unless Coca-Cola's going to sack them and say, right, you guys not doing a good job, we're going to have a, you know, a business not in Switzerland but somewhere else. It doesn't make sense. But this is Coca-Cola. This is them. These guys are in business. So, you know, they ain't going nowhere. So you know that as long as Coca-Cola exists, these guys have got a job. And if as long as they do a good job, they're not going anywhere. They're a solid business. And so you could argue, well, you know, unless technology changes where they start selling the drink itself in some other container that these guys can't supply, then this is solid, right? But I tend not to like this kind of company, to be honest with you, but we'll keep with it. So the question you're asking me is, if you want to buy and hold a company just for a long time, is it a good company to go for? Well, first things first, you want this to be rising, right? Which it is. This is rising. The next question is, okay, so historically, you've been doing well. Good. What about the future? What are you telling me in the future? Now, this is before tax. That's the real number, by the way, for performance reasons. But after tax, this is more like for, if you want to look at it from a dividend perspective, right? This is number for dividends, and this is number from a performance point of view. You don't include tax for performances, right? But you do for dividends. So you take this number before tax as a performance measure. And then you say to yourself, okay, 611 million, great. What's the forecasters telling us about the future? And they're going to be telling us, you know, a big rosy picture. It's going to be 100 million, then 900 million. You can buy this company, just sit on it and wait, because the price is going to go up. Now, remember I told you 80% of the reason why the share price moves is because of this. 80% is to do with other stuff. So if other stuff value the company downwards, and this is going up anyway, but if they start to value the company downwards, right, and it's nothing to do with this, you know it's eventually going to come back to this. This is like reality. So when people lose their minds and then they come back to their proper senses, it's going to come back to what it's supposed to come back to. Do you see what I mean? And so therefore you could ride it out. So a man like Warren Buffett, for example, when he buys shares, he genuinely doesn't care what the share price is. He doesn't care. He's a fundamental trader. And it's one of the reasons why I liked him, and I still like him, because I'm coming from a background where fundamentals is, I understand it. I get it. And he comes from that background where he's basically saying, look, Forget about what the share price is, because we know that's, he describes it as, he says shares is like someone who's got manic depression. You know people are manic depressives, where 1 minute they're happy, next day they're depressed, and nothing's happened other than a chemical change in their head, but nothing's happened. Well, he goes, shit, the stock market is like that. One day, everyone's depressed, and the next day everyone's elated, and they are behaving crazy. The reality is, what's the reality? This is the reality right here. So he'll say, okay, fine. I want to buy some shares when I want to see, he'll have Coca-Cola on his list. I like this company, but right now it's too expensive. I'm going to wait until the stock market goes into a manic depressive mood and gets depressed. When they're depressed and they undervalue the company, I'll buy it. And when they go elated the other way and go nuts and go happy, then I'll sell it to them. Does it make sense? That's his approach. So he will sell it to you when you overvalue the company stock market, and he will buy it from you when you've undervalued it. And that's why his approach works, because he's basing it on fundamentals. And that's his approach. And he was trained by, who was it now? A guy called Benjamin Graham, I think it was. And Benjamin Graham was another guy who believed in understanding the fundamentals. And he was big during the time of 1920s, and when there was a big stock market crash, and he wanted to filter out the noise and see which companies really was valuable compared to the ones which was trash. And they basically wanted to go into that. There was another guy, what's his name? Sir John Templeton. I think it was during the 1970s, if I'm not mistaken, when we had a recession, and he decided again that he was going to just do fundamental trading, and he was going to, so what he did when he was a young man, him and his wife decided they were going to literally save half of their salary, their joint salary, save half of it towards buying shares. He clearly knew what he was doing, because no young man does that without having a plan and having understanding. So he decided him and his wife was going to save money, and they must save money for at least 10 years, 10, 20 years, just saving, waiting for the opportunity when the stock market crashed. And when it did happen in the 1970s, they went shopping. And he literally decided he was going to buy the best, again, doing fundamental analysis, he was going to look for the best companies that existed. And everything that he saw that was going for less than $1 per share, that was in a fantastic company that was being undervalued, he bought it. Here's the bottom line. When the dust settled, he was a billionaire. He was a billionaire. He made him a billionaire. And, these are things, if you understand what you're looking at and know where real value is, when he saw that the company was too cheap, he knew it was too cheap. He went and bought. And so he's a prime example of buy low, sell high, which is a key mantra. But how do you know when the share price is low or high? It's based on fundamentals. Fundamentals is what is really going on in the business. Are they selling more clothes or less clothes? One of the reasons why I don't like Next, the Next company, they're vulnerable to fashion trends. They're vulnerable. Whereas Coca-Cola, they're not vulnerable to nothing. Whether there is a trend or not a trend, you're buying Coca-Cola if you like it. I've never bought Coca-Cola, by the way. I've never drank it since I was maybe, 12. I've never drunk Coke since, no, that's not true. I don't buy Coke. And I might have drunk it at all since I was the age of 12. I would say it's less than 10 times since I've been 12. I've drunk this product. So I'm not their customer. But I do know that whoever likes them, they would buy this drink every day. And they drink it every day. And they're not going to stop because of a recession or anything else. They're drinking it. And there's enough people in the world who like this product to keep them in business. Do you know what I mean?
Yeah.
And that's one of the reasons why Warren Buffett likes the business. And he even said, this company is so big, even him with his billions of pounds can't even compete with them and make a dent in their market. They're just too big. He says, even with all of his money, there's nothing he could do to start up a brand new Coca-Cola company and beat these guys. They're too big. So he says, why argue with them? Just buy them and so he's like a flea. Can you imagine a billionaire being a flea on the back of an elephant? And he's a billionaire? How big must these guys be? He says these guys are just solid. And they're not solid because of the drink, they're solid because of the brand name. The brand name Coca-Cola is so strong that every generation has been sucked into the perception or the illusion or whatever of this company's whatever tastiness, whatever it is that it's part of your culture. It's almost like saying to a Christian, you're not allowed to have a Bible. You lost your mind. I have my Bible. I want it. Or say to a Muslim, you can't have a Quran. No, they want it. Whether they read it or not is another matter. They want their Quran. It's a bit like that. Some people just they need their Coke. Do you know what I mean?
So where does the importance of the PE ratio, price per share, and
no, price earnings ratio? This price earnings ratio is a measure here to let you know whether the company is too expensive or too cheap.
Oh, okay.
That's right. That's a number. Now, you want to not compare it on its own, but you want to compare it with two reasons: with itself, and also with the industry. So, is 20 normal for this industry? That's number one. And number two, is 20 normal for this company? So if this was normally 5p ratio, then it became 20, that's too expensive. If it's normally 20 and it's going at 80, that's too expensive. Do you know what I mean? So you have to go with what's normal for this company. But that's it really. So that's how you would measure that. But this is clearly a measure of whether something is too expensive or too cheap. That number right there. And so you want to pay attention to that, because you don't want to buy it when it's too expensive. You want to buy it when it's basically cheap. And the lower this number, the cheaper it is. Are we happy?
Yes, thank you.
No, you're welcome. I was going to do a calculation, wasn't I? So let's go with Burberry. Am I going the wrong way? Yes, I am. In fact, let's get the chart up from here. All right, so Burberry was in this range and it flew up here. So the question is, what's my return on investment? Okay, that's the question. So let me I'm going to put in a marker. Go here, get a horizontal line. And I'm going to say I bought the share price right here. I'm going to make this blue so it stands out. Okay, so I bought the share price here, which is 1792.8. I just made it up. It could have been anywhere, but I'm saying that's my price. Okay, so the first things first, I went long, by the way. So I went long, and you guys can do this calculation as well. So I'm going to go long at 1792.8. So first things first, what was my dividend? My dividend was 31.5. In fact, let me just do a quick spreadsheet. It'll be helpful for you to visualize what I'm saying, because some of you don't have mathematical visual acuity. So let me get a quick spreadsheet. Okay, so I'm going to put a little spreadsheet on the side. Okay, so what do we know? I purchased the shares on Wednesday. Not shares, purchase price. And my purchase price is 1792.8. That's my price. Now, I will do both professional and non-professional, so you can know what the numbers are. That's my purchase price. So I'm going to get two amounts of money. One, I'm going to get a profit because it goes up in value. And number two, I'm going to get a dividend. Okay. So my dividend is 31.5. And my capital gain, now for this I have to make it up. So I'm going to come in here and I'm going to say Oh, that wasn't very clever, was it? Never mind. Oh, it's this one. Right, I'm going to say that I sold the share price here. I'm just making it up. So my selling price is 1908.7. So 1908.7. So my capital gain is 1908.7 minus my entry price 1792.8. So I have a capital gain of 115.9p, and I've got a dividend of 31.5. So go back to my spreadsheet now, and my capital gain is going to be 1908.7 minus, I'm doing it here visually so you can see what I'm doing, minus 1792.8. That's my capital gain. Well, there's a formula. It would be 1908.7 minus 1792.8. So that's my capital gain. All right. So my formula is going to be, this is my profit. My profit is these two numbers together. Okay, so that's 147. That's my profit. So I'm going to say, I'll do it visually so you can see it, 147.4. And I'm going to work out my return on investment. And then I'm going to do underlining. This underline represents divide. And then I'm going to do open brackets, the price I came in at, which is that price, 1792.8. I'm going to multiply that by my margin, which is 5%. I'm going to close that bracket. And then I'm going to multiply the whole thing by 100 to give me a percentage. And then I'll say equals as well. And that's the formula. So let's now type those numbers in. And what we should have is equals 147.4 divided by, open brackets, 1792.8 times 5%. Move it over. Close brackets times 100. And you can see I've got a return of 164%. If I take away that 100%, take that away, and I'm going to just press percentage button here, and that's doing exactly the same thing. So me times by 100% is the same as me clicking that percentage button. 164% return is my benefit. And if I do the same thing here, copy that, and put this, make this 20% for those who are on non-professional rates, and then make this 20% here. And that becomes 41. So what have I just done? Here's what I did. I said profit, and divide that by the cost of investment. And then times everything by 100. And that's basically it. That's the formula. Profit divided by cost of investment times 100. This formula is what this is. And so when the profit is two parts to the profit, dividend and capital gain, that profit is the same thing. If it had no capital gain, the dividend would be my profit. If there's no dividend involved, the capital gain would be my profit. So the share price, the cost, that's my cost of investment. But because I'm only paying a deposit, then I have to multiply it by the deposit percentage to give me a smaller number, and then multiply that by 100. And this gives me my return on investment. Now, I did it on this, I did it here because I remember someone was asking me for this some time ago. And so I've done it again here. So now you know, when you have a capital gain to be included in, just add it in. And then have a two-part profit as opposed to one-part profit. Yeah. And that's how you do that. But the formula here is still the same. Profit divided by cost of investment is this return on investment. If you wanted to do a return on fund, why would you even care about this number, return on fund? Because the return on fund percentage is what you would put into your calculator for compound growth purposes. And here you would have your opening balance. The opening balance of the fund. So before you do the trade, you've got the fund balance, and then when you add money to it, that's your profit. And so if you've got, say, 20 grand, 25 grand, £1 million, doesn't really matter. You divide the profit by the opening fund, and times 100, that gives you a number. So let's say it's a 3%. Then if you're making 3% a week, then that will go into a compound growth formula. There's 52 weeks in a year. So therefore, let's say that you're only successful maybe 40 weeks in a year, then you will treat a year as 40 weeks, and then you basically do your compound growth formula from there. Okay. And that's, so you want to use this for compounding into the future to see where you're going to be at this kind of performance, weekly performance going into maybe 5 years. You want to use this number. But if you want to know specifically what you did in terms of your exposure, what you invested, then this is the number you want to use. So this number would always be smaller as a number. So for example, if this was, say, let's take this number actually, 164. So I got 164%, that number. And if I used, say, 20% of my fund, that means 1/5 of my, 20% of my fund is 1/5. Then I'm going to take this number and divide by 5. So my whole fund will have grown by 33% in this particular case. Yeah. If I did 1/3 of my fund, then I would divide that by 3, and that would be the return on my whole fund. So it depends how much exposure I do. Okay. If I do by 4, 41%. So that's how that works. Hope you find that useful. Any other questions you have before I let you guys go?
Yeah, Miles. Can you hear me?
I can hear you. I've got the user on there, but no name. Who's the person talking to me?
It's Frank. Frank.
Oh, how you doing, Frank?
On Friday morning, I think I set with Burberry. I set my limit to 18.04, I think. But I think the market opened at 18.22, so my limit wasn't triggered. Is that how it works? So it actually closed me out at 18.22.
You went long, I take it.
Yeah.
So were you very happy then with your Burberry results?
Yeah, but what I'm saying is the reason I'm asking that is that how the market actually works? Because it opened higher than my limit, it closed me out at a higher price, which meant more money.
Yes.
I'm saying, is it because it opened above my limit? That's why it closed me out. It didn't actually trigger my limit.
Well, it kind of did, didn't it?
Well, it kind of did, but at a higher price, at a better
That's
price.
that's because the price that you wanted didn't exist.
Right. Okay. That's what I meant. That's what I wanted to know. So
Yeah.
that's how it works.
Yes, because it can't
Okay.
close you at the price you want because the price you want didn't exist.
Hmm.
It is what
Okay.
they're trying to tell you.
Yep.
What was it, what did you get in that? 1841.
I can't remember why I got. No,
What?
my
1841.
limit was my limit was set at 1804.
I beg your pardon, 1804. So there's 1804 there, and I know why you did 1804 because obviously that was the highest
That's
for the
right.
Wednesday.
Yeah.
So right, so you took the high for the Wednesday, right? And the share price opened here,
That's right.
and because it opened there, you triggered the sale, but not at the price you wanted because it was too high. 1804 didn't exist.
Right. Okay. That's what I wanted to know.
Yeah. So you had a happy experience.
Okay.
Yes, in your case, 1804 didn't exist,
Okay.
but your limit order, but your limit order was triggered, and so they gave you the best price that they could give you then, and it should have been the opening price, which is at 1825
Okay.
or some range within there. Because as soon as the
Somewhere
price,
around there.
as soon as the price opened, you got triggered, but
Yeah.
you couldn't give you 1804.
Okay.
So my commiserations because you missed out on all the profit.
Well,
No,
I was more than happy because
I'm joking.
exceeded my limits anyway. So
I'm joking. And exactly. The attitude you have to have is, look, I hit my targets. I'm happy. I mean, I tell you one thing, Frank. There have been times. This is not these days, but I used to. I used to chase after profits and think, oh, I've done better now. And whenever I jumped in again to get another bite of the cherry,
yeah.
not all the time, but a lot of the time, it would say, "Really? You really sure you want more money?" And then he says, "All right." No, he wouldn't even say that. He say, "Are you really sure you're not happy with what I've given you?" No problem. Take my trade, and it would go down south. I lose everything. Then I'll spend the whole day struggling, just to get back where I started in the morning. Do you know what I mean? And had I just closed out my trade at say 8:05, I'd have been really happy. But then what do? I make a loss, and then I spend the whole day getting the money back. And so by 4:00, I'm exhausted, and I'm literally only slightly up than I was at 8:05. And I just taken the profit and closed the computer. I've been fine. So these are the but well done, Frank. No, seriously, well done. And again, I know why you did that, because you were thinking as soon as it touches it, I might not be in front of my screen. I'll get closed out and I'll be happy. But in this case, we had this going on. So it's all good. That's all for this week. Happy investing. Bye now.